30 pieces of content in 30 days. Today we're going to talk about capital gains. It's when you sell your property, you make a boatload of money, the last thing you want to think about is taxes. So let's talk about two things that you can do to save on taxes when you sell a piece of real estate and you make a lot of money on it. The first thing you have to be concerned about is capital gains. Capital gains are calculated by taking the amount you paid for the property, adding any improvements that you've made, and deducting the price that you get for the property. That delta is generally the amount of capital gains that you're going to have to pay taxes on. Now, there are ways to avoid capital gains. The two most common ways are if you're selling your primary residence and you've lived in it for 2 out of the last 5 years. If you are single, you can deduct $250,000 worth of capital gains. If you are married or you have a registered domestic partnership and you file your taxes jointly, you can deduct $500,000. The other way is if your property is an investment property, you may be able to do a 1031 exchange. Don't do that without proper advice because it's a little tricky. There are some rules that you have to follow or you will not avoid paying capital gains. So with that, remember there are two ways. If it's your primary residence, you may be able to exempt certain amounts from capital gains taxation. And if it's an investment property, you may be able to do a 1031 exchange. I'm going to tell you what every good realtor is going to tell you. That is, one, this is not tax advice, because see, I'm not your tax accountant. You've got to consult with your tax advisor to see what methods are going to be the best way for you to avoid capital gains tax. But now you know there are at least two ways, and you can investigate those further for yourself. I'm Teresa Mack. That's my tip for today, and I've got 29 more to go if I keep my promise to myself and to you.